who's Professor Kevin Chika Urama. And he will be talking about, can Africa finance its own development? Now, Professor Kevin Chika Urama is currently Chief Economist, Vice President for the Economic Governance and Knowledge Management Complex of the African Development Bank Group. He previously served at the bank as Senior Director for African Development Institute and Senior Advisor to the President of the African Development Bank Group on inclusive and green growth strategy, policy development, and implementation. Professor Urama is an elected fellow of the African Academy of Sciences, a distinguished professor at the University of Nigeria, Nsukka, and an honorary professor of practice at University College, London. He's currently a member of the Global Council on the UN Sustainable Development Goals, a commissioner for the Global Commission for Urban SDG Finance, a member of the Advisory Committee of the Alliance for Modernizing African Agri-Food Systems, a member of the UK Foreign Commonwealth and Development Office, or the FCDO's Advisory Board on Climate Compatible Growth Program, a member of the World Economic Forum's Global Council on the Future of Clean Air, among many others. I could go on and on. Before joining the African Development Bank Group, Professor Urama served in various executive leadership positions in academia, in international organizations, and in the private sector. And he served on many different expert panels, which you can see with the QR code. You can see a list of those. He holds a PhD and an MPhil in land economy from Cambridge, so it's wonderful to welcome him back, and has a master's and bachelor's degree in agricultural economics from the University of Nigeria. So welcome and thank you.
Thank you. Thank you very much. Thank you very much. Rather long introduction. It's a big pleasure for me to be here. Coming back to Cambridge after several years of having been a student here and seeing the Cambridge Africa group, what you've done, what you're doing, the excellent sessions that we have had this morning. I'm really, really thrilled. Thank you very much for the work you do. When I was invited, I thought of thinking of a topic that has been troubling my mind for quite some time. And that is how Africa can take charge of its own development. Other partners, development banks, financiers have tried to help the continent to finance development for decades. That is yielding successes. But in my studies of development economics, I find that development only happens organically from home when the owners of that development invests in the development. So this paper, this presentation takes from a report we've just published, the African Economic Outlook Report, which we ask that same question in terms of how we can mobilize Africa's development financing at scale in a changing world, in the fragmented world. So here is just the presentation outline. Before we talk about Africa financing Africa's development, it would be good for us to look at how is Africa doing with regard to its development, given the current financing that we have. And here, this slide is just telling us that the continent is doing well. It's doing well in terms of real GDP growth rates, where the continent is not only now, when I was here in Cambridge, we were hearing about Africa rising, but Africa has risen now and is actually growing at par, even a little bit higher than a developed Asia, which is was the fastest growing region of the world until this year. And if you look at the world growth, those dotted lines there, you find that the Africa's GDP growth rates are estimated at 4.4% in 2024. It's much, much higher than the global average. And that growth is also broad-based because we're now seeing that up to 36 African countries are posting GDP growth rate increments in 2025. And 22 of them were growing at a whopping more than 5%. And even when we look at the impacts of the ongoing crisis in the Middle East, we only estimate that because of Africa's diversity and resilience, the impact will be minuscule. It will just be about 4 percentage point decrease in that high growth rate, bringing it to about 4% GDP growth rate in 2026, but it will bounce back again to 4.4 in 2027. So this tells a story that Africa is doing well when you look at the short term. But looking back into history to see whether this growth is systemic and how we have financed our growth, whether there's a systemic growth pattern, we can see that since the year 2000, the dotted black line there is Africa's real GDP growth compared to its peers, Latin America and the Caribbean, and also Asia. We can see that Africa's growth has started stabilizing at a higher level since 2020. Of course, you see the dips because of COVID and the global financial crisis and so on. But the characteristic of the continent is that it keeps bouncing back because of several drivers of growth that you will find if you look at the report in detail. But where we're not doing well is in the distribution of wealth. GDP growth per capita on the continent trails other regions. If you look at that deep red graph there, so it's doing better than some, just 2 other regions, Europe and Latin America, but still very much below the levels that were identified should be able to create quality jobs for youths and also have structural transformation on the continent. So because of that, the growth is jobless. So we still have increasing poverty, increasing unemployment, and also, Africa is like the poverty capital of the world, even after factoring that high growth rates that we're seeing. And it's because the growth pattern is enclaved, only 10% of the continent consuming almost 60% of the continent's wealth. Why I'm bringing this forward and talking about Africa's financing is because one of the major drivers of these growth patterns we are seeing that is not inclusive, no structural transformation, is basically financial. It's the types of financial flows that comes into the continent that drives this. Because Africa's growth, when you try to decompose into the different regions, you find that Africa's growth is not structural. Countries that have high other drivers of development, like resource-rich countries, are not doing well. But non-resource-rich countries are doing better. And that is why you see Eastern Africa region is the fastest growing region on the continent at a growth rate of up to 6.4%. The Southern Africa region that you expect should have been driving growth on the continent because we have a lot of manufacturing in South Africa and so on, is not doing as well as the others. Why? Financial flows, as you'll come to see later. Of course, another part of the financial flows is what is driving the macroeconomic structures on the continent. And this place, we're just trying to look at the fundamentals in terms of consumer price inflation, the patterns of consumer price inflation, and exchange rate dynamics on the continent. And when you look at this, you find that inflation on the continent is very high. And if you decompose that inflation patterns, you find a lot of that is what we call imported inflation, meaning that central banks in the continent doesn't have much control over how the inflationary patterns happen on the continent, because decisions made by the Fed flows through, and that is because of the exchange rate patterns we see on the continent. Again, the exchange rate dynamics on the continent, if you look at those figures, you say inflation is improving because it's fallen from 21.8% in 2024 to 8.9% in 2027 projected, 10.4% this year. But a 10.4% in inflation, you would know what that means for affordable incomes and investments for the continent. So, and of course, this is just to say central banks on the continent are trying to do a lot of work in terms of, fiscal consolidation to try monetary policy easing and also fiscal consolidation by ministries of finance to try and control it. But those control continues to remain episodic because of the fact that a lot of the drivers of the growth dynamics on the continent are external. And one of the major symptoms of that is Africa's debt dynamics. Here we find that even when you have debt forgiveness and debt restructuring on the continent, debt vulnerability continues to become a problem. Why? The composition of debt on the continent is skewing now towards shorter term, higher cost borrowing for long-term investments. And that just leads to debt refinancing becoming more frequent. And just last year, and the past 2 years, the continent spent about 87 billion US dollars in debt service only, interest rates, not even debt service that includes the principal. So how, answering that question, can Africa finance its own development? We need to take into consideration the global financial architecture that has conditioned Africa's growth patterns and macroeconomic fundamentals to be this way. And it's very important because currently we're talking about private sector coming to the rescue. Every meeting I go to, ODA is declining, but private sector should help. The other one is going down, MDBs and Paris Club lending to the continent is going down, but the private sector will help. This is what it will mean for the continent because Eurobonds has a maturity rate of 10 years. So if you borrow a 10-year loan to build a road that has a gestation period of 35 years, you defaulted before you made that borrowing. And that is where the continent is being driven towards now. Then external debt, because of that short maturity, is taking away that financing, the fiscal space of the continent, is taking it away from structural investments in human capital formation, in sustainable urbanization, in all the things that actually can create sustainable green growth on the continent, because we are spending 31% of government revenue on debt service. And 25 countries, when we did this analysis last year, you find that 25 countries were spending more on interest payments for loans borrowed, more than they are investing in health or education or all those things that make growth systemic in countries. So that's a problem that we need to solve. And when you look at the empirical evidence, you also find that the relationship between public debt and productivity is very worrying. So the continent keeps borrowing, but the relationship with factor productivity and total factor productivity and the quantity of loans that countries borrow is in inverse, which means that countries that borrow more are less productive on the continent. Again, the global debt architecture structures it that way that Africa pays a premium, and also the procurement and the procurement rules that we find crowds out Africa's SMEs and companies from winning awards to build infrastructure and other things. So you take a loan from China and you have a Chinese company come to implement it. So you just have a circular flow. What is left for you to do is to pay the interest on the loan. You may get the tarmac, the road there, but then you have a huge amount of interest to pay, and you have not had any capital formation on the continent. So in fact, you find that 1% increase in public debt in some African countries can lead to 4.9% reduction in labor productivity and 4.6% decline in total factor productivity. So when we ask that question, can Africa finance its own development, we need to be asking, can the global financial system, the global debt system, allow Africa to finance its own development? And this slide epitomizes it for me, because when you try to look at ratings, sovereign ratings, which defines the cost of capital, you see here on this slide that GDP per capita, which is where Africa is not doing well, is very highly correlated with poor ratings. And when you have poor ratings, your cost of capital is up, and then you are going to pay a huge premium for borrowing from the open market. And because of that, the continent is spending quite a lot repaying loans and not doing development. On the other panel there, look at this is work done by Moody's Analytics, and you find that Africa is the least defaulting continent for all long-term investments that is done on the continent at 1.9% compared to 4.6% in Western Europe and 12.4% in Eastern Europe. So what this means is that the continent is constrained to pay debts instead of do development. And if you look at this, the other thing down there, you'll find that Africa's public finance efficiency gap is at 41% compared to 1% in Europe, which means that every $100 borrowed by an African country, 41% of it goes towards things that are not creating capital accumulation on the continent because of international procurement rules, because of corruption in the countries, lack of institutions in the countries, lack of rule of law, and transparency, accountability. There are so many things that are driving those things. So there are so many headwinds which financing Africa's development keeps facing. I'm not going to go through all of them, but when you look at that, you find that only 2 of them are internal for the continent. The rest are globally driven. So Africa's ability or inability to finance its own development is not within the African governments alone. It's a global consensus in terms of reforming how financing flows. So because of that, we have huge gaps. My colleague is going to talk about climate finance, and then you find that the continent, to implement its NDCs, we have a gap of $213 billion US dollars every year. The same continent that spends $87 billion repaying debt, servicing debt, is supposed to spend $214 billion. Now, structural transformation on the continent, we have a gap of $402 billion, just be adding it up, and then doing SDG, we have 1.3 trillion. So huge amounts of resources that are required to finance development on the continent. But how is the continent doing in terms of, there are normally 2 patterns of financing development: domestic revenue mobilization and external financial flows. So how are we doing with domestic revenue mobilization? Because of that structure of the economy that I have talked about in terms of macroeconomic fundamentals, countries on the continent are doing well by increasing nominal revenue collection, but are not doing well in terms of tax productivity, in terms of when you look at tax. So because that red line there is showing that tax to GDP ratio has been declining for the past decades, even as the continent is collecting more and more taxation because of several factors I'm going to come to after that. And then when you look at how Africa is doing with the rest of the world, you find that Africa is performing the least than all the other regions. Now look at non-tax revenue, the same pattern. Nominally increasing, non-tax revenue to GDP ratio declining. So tax productivity is low on the continent. And again, when you look at this, we're only second to South Asia in terms of the performance on that. The second way to mobilize this is mobilizing long-term capital from MDBs and pension funds, sovereign wealth funds, and all these other kinds of funds. But when you look at all the indicators, Africa is at the bottom of it. When you look at financial development index or gross savings on the continent or domestic credit to the private sector and private investments on the continent, we perform worse than all the other regions of the world. Again, because of those 2 factors, exogenous and endogenous factors driving development on the continent. And our footprint with regard to capital markets remains disproportionately lower than in other regions. Right there you see global assets in terms of pension funds and sovereign wealth funds on the continent. You can see it's very like a dot on the map compared to other regions. And then if you look at the share of global capital markets, we have the same problem. 0.3% of private credit, corporate bonds is 0.1%, and everything is like, my little daughter sometime told me, Daddy, if you want to look for Africa on the map, look at the x-axis. So external financial flows, in the midst of all these, remember, the drivers of development on the continent are domestic and external. But external financial flows on the continent has been going down over time in real terms. And even more recently has become more episodic. Of course, we know ODA is going down. FDI will continue to go down as countries are now beginning to reprioritize national security and other things. But one key aspect which the continent is underinvesting in and supporters of African development is underinvesting in the diaspora. The African diaspora has remained the most sustainable, resilient, and highest financial flow to the continent every year. But the issue is, it is coming in, like last year, it's 104.6 billion US dollars. That's 38% of all the financial flows that came into the continent. But it is not structured. It is going into consumption smoothing. My mother is sick, my brother is going to school, and so on, and not going into structured investment. So MDBs like ourselves need to come up with a structure that encourages the diasporans to now invest not only in consumption smoothing, but also investing in infrastructure, in education, in health, and all those things that drives development more sustainably. And you will see later that with such structures, these resources is estimated to reach about 1.1 trillion by 2050. And of course, ODA is going down. I won't talk so much about it. Someone has talked about the shock. I think it was John in the morning, the shocks that we get that create that problem. But here you can see different countries, including us, United Kingdom, we are reducing ODA to countries when the financial needs are increasing. And they're expected to do climate, they're expected to do health, they're expected to do SDGs, and so on. And we know that the policies we make in our countries affect their macroeconomic fundamentals. So their growth is not their responsibility alone. So again, it's just food for thought. But the other side, which Africa has a lot of, is natural resources. The continent is awash with natural resources of every kind. But because of extractives, the relationship we have with natural capital on the continent is more of extraction rather than value creation. We find that despite the huge minerals for green development, we are not investing in that on the continent. And we have the blue economy that's worth over 106.5 billion. That is not being invested in sustainably. And the research we just did 2 years ago that was launched at COP in Azerbaijan shows that only by investing in building nice, good capital carbon markets on the continent to capture carbon sequestration from forests, the value of carbon sequestration from forests can lead to $66.1 billion increment in Africa's GDP that year. So, and the informal sector continues to thrive on the continent because African governments are not getting their act together. I think John also spoke about trust. Our policies are not reflecting to trust, so citizens are preferring to operate in the fringes instead of coming into the mainstream. Almost 40% of Africa's economic activity are informal. You will see later that by just formalizing this, the continent can mobilize over $125 billion every year. So, but the African economy in terms of financing is now also more like a basket case. Basket case in terms of the amount of leakages that we're seeing on the continent. The last time we tracked this in 2022, we have poor risk perception on the continent that's not based on facts. It's costing the continent about 74 billion US dollars annually. Of course, illicit financial flows, almost 90 billion annually. And then corruption, 148 billion annually. And then we have international profit shifting by big conglomerates from the developed world on the continent that is supposed to be poor. We're having 275 billion US dollars that's supposed to be government revenue that is being leaked because of the loopholes in the global tax architecture. Totaling, only tracking those 4 leakage points that are we can see the trace of the money is up to 587 billion every year. So if we had that 587 billion retained on the continent can finance its infrastructure needs, which is 402 billion. Let that just sink in. But then, poor investment efficiency gaps on the continent because of procurement rules and other things, but also including lack of bankable projects and so on, as of 2024, cost the continent about 209 billion annually. If you look at all these leakages, just plug in them, which takes global coalitions to be able to plug these leakages, then the continent can finance its own development. So, but that is not to say that the effects of not being able to finance is only external. The countries themselves need to do something. And here we just try to track the potentials that we have in tax and non-tax revenues if only the continent does what other regions are doing. Like if we adopt the policies of the UK and Europe, the continent can, from the different tax instruments, VAT, personal income tax, import duty, and the rest of them, all these are potentials, the things that we could mobilize already if the continent only implemented those good policies, which are being implemented in other countries. So from tax revenue, it's 406.4 billion that we are leaving unmobilized. And non-tax revenue is 301.6 billion annually. We are leaving unmobilized. In total, that's over 781 billion. So even if the continent did not mind about the leakages and other things, but focuses on effective mobilization of domestic revenue, we will still be able to meet our infrastructure needs. So this is for the African countries to do. And then additional capital from the diaspora, I've already mentioned this. This is a huge aspect, and this is why in terms of mobilizing with regard to the intellectual capital for the continent, what I call brain circulation, tapping all the brains. People have been talking about going back to Africa. You don't need to go back to Africa. The world is a global village, and you can contribute to the continent from anywhere you are if you want to contribute. But we need the policies, the enabling environment that allows the diasporan to be able to do that. I call that brain circulation. And again, this is a huge potential, and these are instruments that governments can do, but also reducing the transfer costs, which is not by government. But if I want to send $100 to my sick mother, you know how much that will be taken by the global banking systems. Then other sources of potential additional revenues, long-term institutional capital on the continent has $4 trillion of assets under management, but only 2.7% of that is being invested in Africa. Why? The risk premium and other things. So by just increasing the percentage of Africa's own savings, sovereign wealth funds that are being invested on the continent, a lot of the financing needs can be met. And the other things you find there, we have high net worth individuals on the continent controlling over $2.7 trillion, and philanthropies on the continent up to $2.7 trillion. And I've talked about the natural capital potential and the formalization of the informal sector. So the answer to that question is, yes, Africa can finance its own development if we have the global system that allows that to happen, and then if we have African governments that are serious in doing what other governments are doing in order to mobilize, retain, and deploy capital effectively to development. And here are just some of the things that came out of our analysis in terms of what should be the key for unlocking these huge potentials: strengthening institutions, increasing transparency and accountability, interoperability of systems, digitizing the PFM systems, investing in human capital, improving factor productivity and public service delivery, and more importantly, strengthening the trust, what John called trust, I call it social contract, between citizens and governments, will unlock all those domestic revenue that we have not been able to tap, because it will reduce implicit tax burden on the continent. In many countries in Africa, citizens pay taxes informally. You build your own roads, you have your own security, you have your own electricity, your own generator, and so on. So when the tax man comes through the door, you're wondering, what are you doing here? I am my own government, something like that. So we need to try and address that. And this is just to say that I am not manufacturing that. The citizens of the continent in the survey that's been done shows that they are willing to pay more taxes and more voluntarily taxes if the governments just simply did these 5 things. Let us see that there's fiscal prudence in how those public resources are being utilized. simplify the tax system and efficient tax administration, and also transparency and accountability systems. Let's see the public services being delivered so that I don't have to do it twice. This is for African governments. We need to strengthen our public finance management, and this is just to say we're not manufacturing this. This is about research and evidence. We see that in terms of trends in budget transparency, Africa is second to the Middle East with regard to untransparent budgeting systems by governments. And then also, when you look at budget credibility, Africa is at the bottom. And you just think about countries that you are working with on the continent. Digitizing the public financial management system delivers the highest dividend. And the technologies we have now is allowing everybody to be able to do that. Here is the efficiency in investments and digitization. So that 299 billion I talked about could be saved if the procurement systems were properly digitized and so on. So here science and technology comes in very strongly. But again, sequencing in policies, because quite often ourselves, the IMF and so on, we present these beautiful graphs and everything, and government say, oh, we need to do something about it. Oh, let's remove subsidy. Removing subsidy is good, but how you remove it is also more important. So, and that is why the sequencing of the policies is very important. Because if you remove subsidies and you don't have good rule of law, transparency and accountability, you may just be mobilizing more resources for embezzlement. So we need to think about the sequencing that needs to happen before we go into detailed, stronger these things. Leveraging the private sector is important, but first, we need to have strong and predictable regulatory frameworks, good macroeconomic environment before that can happen. And this is just to say that investing in economic governance delivers a win-win for resource mobilization and utilization. So if you look at public investment efficiency and governance ratings there, perfect correlation. And then we estimated how much actually you can mobilize simply by investing in macroeconomic frameworks on the continent. Huge amounts of resources. You can look at the gaps for countries that doesn't have that and those that have in terms of GDP growth and the rest of it. And to do that, the continent needs to rethink its own financial system. Because quite often I come to these kinds of conferences and we complain about colonization, the global financial architecture, but you're not doing your own job at home. So the continent needs to develop what we have called in the bank a new African financing architecture for development, NAFAD. The new president of the African Development Bank, President Sidi Otta, has engaged with all the African MDBs and DFIs and so on to try and what can we do so that we can at least mobilize that 4 trillion in our own savings and pension funds and so on to be able to help in our development. And 4 core principles came out in those consultations: effective coordination, subsidiarity, complementarity, and disciplined risk transformation. Because again, we cannot deny the fact that risks are more in poorer countries because you have fragility and other things that make capital uncomfortable in those places. So we can't shy away from trying to address some of those challenges that we have. So based on this, I think the answer is very clear. I asked the question, can Africa finance its own development? Yes, we can. But to finance our own development, there's a lot of work that African countries need to do, but there's a lot of work that African partners need to do in terms of the development community. So here are some of the policy recommendations that we can look at. And to give time for discussion, I'm not going to go into too much detail. But one, fiscal discipline and policy coordination is central for all the countries that we've worked with. We'll find that where you have better prudence in PFM, public finance management, in budgeting, transparency, credibility, and debt productivity, public investment efficiency, and creating buffers in good times instead of embezzling the money, you have higher domestic revenue mobilization. You have higher foreign capital inflows. You have better investments by the private sector. So money is there looking for safe environments to be invested in. So I always tell politicians that money for me is like water. When you dig a pond, and in Africa we have ponds to collect water. When you dig a pond that is not leaking, when there's rain, water will collect there, whether you are at home or not. But if you don't have a pond, it will create erosion. If you have a pond that is leaking, it will collect there, but before you come back home, it has drained. So we need to make sure that we have institutions, environments that can attract capital, retain capital, and deliver capital effectively. We need to focus a lot more on domestic capital mobilization so that the philanthropy and goodwill of development partners will be leveraged to do more, instead of development partner resources becoming the source of development. It has never happened anywhere in the world. It's not going to happen in Africa. So domestic revenue mobilization, domestic capital mobilization is fundamental, and we need to try and deal with that more and more. We need to integrate the continent. We keep complaining about colonialism, but we will emphasize the maps drawn in Berlin without any Africans sitting there. So we have visa restrictions for Africans. How can you have trade and investments when the richest man on this continent, on the continent of Africa, Dangote, needs 32 visas to travel around the continent? But as a British, I don't need any. So how will Africa finance its own development if the countries themselves don't invest in opening up the markets and creating a larger market for us? And ACFTA is important, it's there, but let's implement it, not by word of mouth. And then the other one I keep talking about is the diaspora resources. We need to make sure we leverage the diaspora and the high net worth individuals and philanthropies on the continent. That's number 7 on the map there. I've talked about reforming the African financing architecture. We have developed 3 main instruments to address those challenges we saw in the macroeconomic framework. One is the new African Financing Architecture for Development, NAFAD. I've explained what it is. The other one is AFSM, the Africa Financing Stability Mechanism. This is an instrument we led with the African Union on creating a financing institution, a financial instrument to address debt refinancing on the continent. Because currently, Africa is the only region that doesn't have it. And what that then means is that anytime the continent is having any debt challenge, you run to IMF, and you know what it means when you have an IMF staff program, and so on and so forth. We need that to happen. We also need the African Monetary Institute, because I talked to you about how exchange rate is a major problem, both for our debt and other things. If we have an African Monetary Institute, it's just like the European Central Bank. It can lead us to addressing those challenges that we have. Finally, because I have to close, other development partners also have work to do. And that work to do is that we need to deepen international cooperation in supporting Africa, not by addressing our own priorities, but the priorities of the countries. Domestic revenue mobilization is central. We need to try and deal with that. We need to have de-risking mechanisms even as we try to reform our risk appetite in order to allow capital to flow to where the world wants the capital. We want sustainable development. The money is flowing in reverse because it's not going to areas where the sustainable development needs are highest. Why? Risk mitigation and other things. So, ladies and gentlemen, this is the most that time would allow me to talk about, but all the resources are here with the QR codes. Whatever I've said, if you look at those reports, you get them in a better form. Thank you very much.
Thank you, Professor Urama, for a brilliant talk that I think corrected some misperceptions that many people have and was actually quite hopeful. We have time for a couple of questions, but please don't make a statement. I mean, if you can ask a question, because we only have a little bit of time. There, right there in the back? Or can't?
Wow. Thank you so much. Yeah, Professor Urama, just want to ask, did you study the Chinese will I say, transformation on how they did the same thing? And if you did, are there top 2 takeaways you think Africa can implement? I don't know if you get my question.
Okay.
Do you want to collect a couple? Or?
Yes, let's collect.
Yes, we'll collect a few. So China.
Thank you for a superb talk. Could I ask you to say a bit more about African stock exchanges, please, and their potential role in development? Thanks.
There's one down here. Then yeah.
Thanks, Kevin. I'm particularly interested in the leaks around risk perception and what you see as the role of intellectual capital to de-risk in that way, because often the sources of those bits of information come from lack the context, but on the other hand, we also have this wealth of intellectual capital that perhaps are not speaking to and informing those risk perceptions in a way that are more accurate. So I'd love to hear your thoughts on, in thinking about these mechanisms, how intellectual capital can be harnessed alongside the financial capital, particularly in the diaspora.
Yeah.
Thank you. Very important questions. Is this working?
I think it is.
Okay. Let me start from the risk perception one. Obviously, intellectual capital is central in everything because the understanding of the risk and the appreciation of the context on the African continent is the most misunderstood region of the world, if this is not an overstatement. Because quite often, the experts that describe Africa are not African. And many of the experts that describe Africa maybe have been to Africa 1 or 2 times. And that is where, for me, the African diaspora, the work that Cambridge is doing, the Cambridge Africa group is doing, is very important, because I used to tell people that I have the go-between advantage. I was born in Nigeria, I grew up there, so I understand the place. And then I studied in Cambridge. I have grown most of my life in the UK, so I also understand the culture. So that go-between, which the diasporan brings, is very important, both in the interpretation of the risks, the narratives that is created about the continent, because a lot of the risk ratings are perception-based as well, and then also the solutions that can work. Because quite often, the solutions we think works in the UK may not work in Africa. I always say that in development, this is a place where the statement that what is good for the geese is good for the gander may not be correct, because maybe the digestive systems of both animals are different. So it's always very important to think about the context. And that is where I see the work that I'm seeing coming out of Cambridge now on the intellectual capital of the African diaspora. Mapping it, harnessing it, and using it to inform policies on both sides is critical. On the other one, on China, yes, I've studied China quite a lot, and many of the other Asian miracles quite a lot. And a lot of the policies and programs are driven organically from inside. And other engagements is partnerships, not begging. So and this is where Africa, including the African experts in Cambridge, needs to change our mindsets. Nobody can help you if you don't help yourself. Your best neighbor is the one who helps you to do your own, implement your own vision, not the one who creates the vision for you. And that's what I learned from China, South Korea, Singapore, and the rest of them. So that's, for me, one big takeaway, that Africa must, how did John put it? Ask his own questions, find his own solutions, and then look for partners to help implement those solutions. And then on the capital markets, certainly, one of the major challenges in one of the slides there, you find that our capital markets are so shallow, and because of the divisions that the boundaries created in Africa has caused, we are still orchestrating those divisions and not creating scale. So my vision would be an Africa where, for example, the deepest capital market on the continent is the Johannesburg Stock Exchange. Why can't the continent rally around building a bigger Johannesburg Stock Exchange instead of every country trying to have its own, when the depth of that stock exchange is so shallow that it really cannot make a difference? Because in financing, scale matters. If you do a project of $1 billion, you will reach more people than a 100,000 project. And it takes almost the same effort, if not more, to structure a project for 100,000 and for $1 billion. So that issue, that's why regional integration becomes central for the continent. I'm not saying for us to disregard the map, but at least let's allow the flow of capital, the flow of intellectual resources, the flow of human capital. If we have free visa movement on the continent, like Europe does have, we will see better quantum growth in trade, in stock exchange performance, and others than we have currently. I think these were the three questions.
Yeah, there was one person who really wanted to ask a question right there.
Okay.
Good afternoon. So my question comes from the slide where you were showing informality, right? When you were saying that the average is 38%, and then on your far right you saw there was Zimbabwe, which was a 60%, and currently now is a 76%. And in 2019, the finance minister said austerity for prosperity. And then we've been seeing an increased rise in informal sector because taxes are very high in Zimbabwe. And there's now compounded austerity, where you see austerity at national, local, and even in the household level. So my question then comes to you as in, how do we then mobilize resources when already austerity is choking ordinary households in Zimbabwe? I'm asking for Zimbabwe. Thank you.
We'll take one more question.
Okay. Go ahead. Anyone?
Right there.
Thank you very much. Speaking about helping ourselves, instead of the slide on taxes, can I work with you on a slide on markets? So, Africa has a massive market. On agriculture imports alone, it's at least $80 billion a year. That is power we're giving away. And we're giving away to companies that send us really, really bad stuff for the environment, for our health. So how can we claim that power and create value and employment locally? And my second question, why don't these things happen? I think you ask us a lot of questions, but you are the leader who's in the pedestal. Why don't these things happen? We have been hearing about Africa Rising for such a long time now. Carlos Lopez has been talking about structural adjustment programs in Africa a long time ago. To allow Africans to travel, it requires decision. It's just a signature. It doesn't require aid. It doesn't require capacity building. And we've seen it happen in Ghana, in Seychelles, in Rwanda, and the results are amazing. So why don't this? It's really frustrating to look at all these low-hanging fruits that nobody's doing.
Okay, thank you very much. Let me start in reverse as well. First, why is it not happening? There are internal factors, but there are also external factors. Because let's always remember, in politics, there are no values. There are vested interests. And the geopolitics of development has vested interests in the current status quo. So it will take strong leaders and mass movement of citizens in terms of citizens awakening intellectual capital, if I have to go back to that, for citizens to understand and demand for what is good for them. So that is one. And then governments themselves also need to understand the implications of those policies. Because if you go to some of them, they tell you, oh, if I open my market, oh, I'll be flooded by poor people from the other regions. But again, just learn from Europe. That's not necessarily the case. So it's about understanding and so on. So, but it's not that it's not happening. It's happening, but maybe not at the pace that we all want to see it. Like you can see that growth is stabilizing. If you look at every indicator, the continent has been doing well in the past 20 years. And it takes time to build a sustainable macroeconomic policy framework that is broad-based. And we're seeing that the growth is becoming more broad-based as well. So it's not, everything is not bad. There's quite a lot of pockets of good things happening So my passion is for us to scale. And it will take all our advisories to make it scale. Because one of the things finance ministers tell me in the continent is, yes, you come with all these analyses. I want to implement local content policy in my critical minerals sector so that I can trap the resources instead of exporting raw materials and buying finished goods, what we are talking about. But then once you leave my office, I'm going to get another person who is coming to tell me, no, liberalize, because that's what macroeconomics says. So liberalize, import, and so on. And when you do that importation, you stifle small SMEs. So it takes countries to be able to adapt development policies and textbook economics to national realities. When I came to Cambridge first, one of the questions that brought me here, somebody was asking for questions, is that I did not see that macroeconomic works in Nigeria. Because I was seeing more poverty with more structural adjustments. But it wasn't macroeconomics that was the problem. It's the implementation of macroeconomic policy in my country that was a problem that time. So it's about adapting to your context and not copying to paste. So that's the issue on that one. And the other question was forgotten.
Zimbabwe.
On Zimbabwe. So it's also similar to what I answered here. Remember the slide on sequencing of policies. Policies are good in themselves, but it depends on the dosage and the time. I mean, I think there are many medical doctors here. If I have headache and you give me 10,000 milligrams of aspirin, maybe you're killing me. But if you give me the right dosage at the right time, I'll get better. So it's about that timing, sequencing, understanding your own context, not simply because maybe IMF staff monitoring program says you need to increase taxes. But when, how, to who, and what are you supposed to be doing? By the way, the figures I was showing is without any increment in taxation. It's about improving efficiency, improving transparency, and increasing voluntary participation of citizens in governance by paying their taxes. So I'm not a fan of increasing taxes, because again, if you look at the tax buoyancy on the continent, and how many percent of people in Zimbabwe actually pay taxes? Very small percentage if you look at the African continent. So if you are increasing taxes, you are just increasing taxes on those who are already voluntarily paying taxes. And that's where you can see it will drive more people to the informal sector. But if you improve the social contract between citizens and the government, then people will see the value of, instead of me trying to buy a generator to have electricity, I can pay for the government to give me electricity at a cheaper price. That's what taxation means. Then you broaden the tax base and get more tax revenue without improving the structural, fiscal penalties on businesses and individuals for paying taxes. So again, it's about sequencing. For me, if there's one thing we need to take away from here, is that what is good for the geese is not always good for the ganja in development. Context matters. Culture matters. Stages of development matters. So let's not copy policies that work in Nigeria and try and think that it will work in South Africa. We need to study the South African government environment. We need to ask the South Africans themselves what they would expect. And when you engage in that collaborative policy making, you are going to get better research questions, better policy in the policy direction that you don't need to sell to people when it's made. One of the research I did here when I was in Scotland on an European Water Framework Directive was a finding that public participation, that was when public participation was coming up, improves policy uptake by 60% before the policy is made, simply because you engage the people. So it becomes their policy, not a top-down policy. Let's do more of that, and then you can see that there's a lot of innovations and ideas among African youths and women. The boys and girls on the streets of the continent, they have solutions for the problems because they are the ones living in those problems. Thank you.
Thank you. Um,